Good evening, everybody. I wanted to thank you for joining me for this webinar about how retirement-focused investors can achieve financial confidence so they can live a comfortable lifestyle. And I'm going to give you some tips about things that you can do to help prepare yourself for retirement. It's something that we all think about, but not everybody does a great job of preparing for it or doesn't really go about setting goals, and they kind of take a haphazard approach sometimes. So who's this seminar for? It's primarily for people who are in their 40s and 50s or trying to find financial balance. You know, if you have a family and you want to maintain your lifestyle in retirement, because when you have a family, you have lots of competing things to worry about. You may want to help put your kids through school. You want to be able to take vacations and spend some quality time with your family. It's for people who want to figure out how to balance all those things. It's also for those who want to be more informed about what retirement might hold in store. Typically, people that I work with have at least $250,000 in investable assets, but that's not always the case. Sometimes it can be less, sometimes it can be more. It really depends upon the needs of the individual. What are we going to cover today? Well, we cover a few different things. We cover building a solid foundation for retirement, and in a minute we'll start to talk about what that means. Part of that's understanding where we are today. It's also knowing where you want to go. And you have to create a retirement roadmap. I call that, for my business, I call it a pathway to an informed retirement. And it's also important that once we have this path in place, that we have a system to help us stay on course, because it's real easy to lose track and to get off course. And if we do that, it's a lot harder to achieve our goals. My promise to you for tonight is that I'm going to provide a step-by-step process that helps you be more confident about retirement and allow you to live that comfortable lifestyle, so that we don't just have to worry about, can I do this or can I do that, or can I get there or can I not get there? It's really important that we want to be more confident about it. We want to have a better understanding of what it takes to get there. But does this sound like you? Before we get into all the good stuff, I'm going to check in with you and see. Do you know you need to save for retirement, but you're not sure how much? Do you have children that you want to put through college, but you don't really know how much to save? There's so many different options, and those different options revolve around what way do you save, because there's lots of options. You can put them into 529 plans, you can put them into an account in your child's name, you can put them to an account in your name, you can even use things like a Roth IRA sometimes to help save for college. And each one of those things has different implications for financial aid purposes. It also has different implications for your child and the accessibility of the money and what can be done with it. And part of the issue that this also relates to is we all want to have special memories when we're built, and we want to put our financial plan in place. I know in my family, it's been really important to us that we try to take some nice trips with our family, because I remember when I first married my wife, that my father-in-law took us on trips. We went on a Disney cruise, we went to Las Vegas, we went to a couple other places. And remember, my wife and her siblings went. And I looked at my wife and said, you know, this is something that we really need to do. We need to make sure that we take our kids on trips when they're young. So hopefully when they get older, they'll want to come with us, and then we'll be able to come, you know, bring their grandchildren and have them come with us as well. So that was kind of the thing that we wanted to set up. We want to make sure that we could create those special memories. And I think a lot of people are like that. There's so many people these days that seem to favor experience over things. Toughest of all is these goals that we're talking about. They can compete with each other. And so we have to figure, how do you balance them? And we can be concerned that instead of being able to achieve all we want, we end up falling short in all regards. And that's kind of the worst of all scenarios. If any of that sounds like you, I have good news. None of those things are the real problem. Those are just the symptoms. The real problem is what I call the shifts. And we're going to talk about what those are in just a second. But know for now that once you make those shifts, you can have your pathway to an informed retirement, and it's going to be easier to make decisions on the fly, and we won't have to make them without knowing what their long-term implications might be. Once you have a roadmap to an informed retirement, you'll know how much to save for retirement. You'll have confidence in your savings for retirement and their ability to help you have the retirement that you want. You're going to feel more prepared to allocate your savings to different goals. And you're going to feel more comfortable having experiences today while also being able to save for tomorrow. For those of you who don't know me, I'm going to tell you a little bit about me. I started my career as a CPA. I worked in the tax department for Deloitte. Originally, I worked on all kinds of taxes. I did individual taxes, I did partnership taxes, I did corporate taxes. I ended up specializing in international corporate tax planning and research, which is really helping companies figure out how to move money around the world at a minimal tax cost. If you think about, or if you heard in the news about companies that have lots of money overseas and it's kind of trapped there, and there's been tax legislation to try to make it so that we can get it there. Well, back earlier in my career, some of the work that I did was really what led to having some of that cash trapped there, because we help companies come up with these strategies. The tax rates of corporations were very different then than they are now. And so we would help them put these build low tax jurisdictions, holding companies and things like that. And then they could move the money through those companies. But then as the US tax rate stayed the same and the tax rates in other countries went down, that money got trapped because it became too expensive to bring it back. I'm also a CFA charter holder, which is Chartered Financial Analyst designation. And when it comes to investments, that's probably the most important designation that there is, because it's a rigorous program. It's a 3-year program. I did it through self-study, but it covers all areas of finance, from investing to portfolio management to fixed income and stocks, and there's accounting and there's ethics. Ethics are really important in the CFA world. I've been writing on financial topics for more than 20 years. I started that when I was writing for the Motley Fool in the mid to late 90s. I remember when my first son was born, sitting there, and while I was feeding him his bottle late at night, he would be in my lap, and I'd be writing articles for the Motley Fool on my computer. I created Apprise Wealth Management and my pathway to an informed retirement as a means of sharing what I've learned during my career to help others to be able to have a comfortable retirement. I specialize in helping retirement-focused investors embark on a path towards an informed retirement. And the reason I use that word informed is because the word Apprise, I deliberately chose that name for the firm because Apprise means to inform. So I like to help people understand. I like to inform people, and that's part of what I like to do. If you go to my website, you'll see that I have blogs. I blog every week. My weekly blogs, I share some of my favorite things that I read each week, and then I'll also have some longer form blogs. The most recent that I wrote was a few weeks ago on behavioral investing, which is really how our behavior can get in the way of our investment performance. And I'll talk about that. I have a good slide for that a little bit later in the presentation. So here is my signature solution. I'm going to just go through it briefly here. It's got kind of 3 levels, this pathway to an informed retirement. We start with an understanding. So it's helping to understand where you are today and where do you want to go. Then we build a plan that helps us get on the path to that retirement. And then we have a number of steps that we have to take to help maintain once we have that plan in place and stay on course. At the beginning, like I said, we have to understand where we are today. That's really important. So like I said, it's that understanding where we are today. There's 3 pieces to that. For me, the first part, whenever I meet with anybody new, it starts with a strategy session to understand, are we a match? Does it make sense for us to work together? Then we want to understand, it's not just about the finances, it's also about the soft stuff. What are your goals? What are your dreams? And what are the biggest challenges you face? Because we want to make sure that the plan that is put together, or you want to make sure the plan that you put together is designed to help you achieve those goals and dreams and help you to address those challenges so that they don't keep you up late at night. And then if you have a plan, you want to look and see if it's up to date. Understanding is an important word. It's kind of like, if these are Venn diagrams, if I go back to my math days, understanding is kind of like the intersection where thinking and feeling overlap, or we're revealing and listening. That's where they overlap. That's what understanding is really all about. It's knowing both sides, right? It's not just knowing one. It's understanding what knowing that you want to do something and how you want to get there, and how you're going to get there is really what I meant there. You want to build a plan that fits your goals and your lifestyle. Everybody's plan is different in some way from somebody else's, because it's got to fit and be what's best for you. We talked about what do you want to accomplish? What are your goals? So I think of goals in different ways. We have our short-term goals, the things that are in the next 0 to 2, 1 to 3 years. It's having an emergency fund. It's if you have any credit card debt, you want to be able to pay off your high interest debt. You want to be able to take care of your loved ones at the holidays. You want to be able to have a vacation every year, every 2 years, whatever the case may be. Have an emergency fund. If something goes wrong with the car, you want to be able to take care of it. Our medium-term goals, that's where we have a bigger emergency fund. We want to build that. And usually I think of an emergency fund in terms of having 6 months of expenses. We want to be able to have money set aside for home repairs and renovations. Periodically, we're going to need new cars. And they don't have to be brand new, by the way. Buying a gently used car can be a really good way to cut down your car expenses a lot. And depending upon where you are in life, your medium-term goal could include putting aside money for a down payment on a house. It could be planning for a child. I know when I work with a young couple, I talk to them about what their plans are for the future in terms of what kind of family do they want to have? When do they want to have children? How many do they want to have? What kind of education do they want to provide for those children? It can include starting a business. And for many people, especially in today's world with the high cost of education, it can include paying off student loans. Longer term goals are things that are further out in the future. So when your kids are young, saving for their education can be a long-term goal, but as school gets closer, that can be medium-term, it can even be short-term. Long-term goal typically for the people that I work with includes preparing and being ready for retirement. So here's kind of like a before and after. So I use financial planning software to help look at a plan and understand what somebody's chances of getting or having a successful retirement might be. And so you can see in this example, before we made some changes, the software assessed their chances of having a successful retirement. And that just means having enough money that you don't run out during retirement at 65%. And then with some changes to the plan, it can go up to 92%. And this is determined by something called Monte Carlo analysis, which looks at historical market returns under a variety of scenarios, looks at your spending patterns, looks at how much money you save, looks at how the market has historically done, what are your goals, and looks at all those things and tries to figure out and assess what are your chances of being able to achieve the retirement you want in all these different scenarios. And then this tells you kind of how many of those scenarios end up with a successful retirement and how many don't. It also includes how do you allocate those assets that you do have in your portfolio. One of the things that I mentioned a little bit before is emotions. Emotions can have such a big impact on our investing, a huge impact, because emotions can cause us to do exactly the wrong thing. That can result in us buying high and selling low. In other words, when the market's going up, we get really excited, and that's when we want to buy because we want to participate. And when the market goes down, we get afraid and we sell. And actually, that's absolutely the worst time to sell. And buying at the high is the worst time to buy. So it's helpful to put a system in place to help eliminate some of that emotion that tells us, here's what we think our portfolio should look like to achieve that retirement. Here's when we should make adjustments. Instead of letting our emotions dictate that, we can let rules and processes dictate that. Also have to understand, what level of risk am I willing to take? Risk tolerance can be defined as an investor's appetite or comfort with volatility, an innate personality trait that remains fundamentally static over time. But if it's so static, why does it seem that some clients' risk tolerance collapses when markets get volatile? We saw recently, just to give you an example, I spoke to a woman a couple weeks ago who told me that in October, when the market started to fall, she got afraid. She sold everything that was in her portfolio, incurred a huge tax bill. Even worse, if you go back to the market's lows in December, right? So she missed some of those lows, but then a week or two ago, the market hit an all-time high. She hasn't gotten back in. So that's the problem when we make that decision because we're afraid to get out. How do we know when to get back in? And our risk tolerance, we think it's one thing, but it might be something entirely different because our actions might not be the same as what we think they'll be. So this is one of my favorite charts. This is called the cycle of market emotions. The source that I found, it goes back over 20 years. So what this kind of does is it talks about just what I was going over. So you can see if you start on the left, when we start investing, we're optimistic and the market goes up a little bit and we get excited. And as it continues to go up, we get more and more excited and we feel great about our investments. If they keep going up, we hit euphoria, and that's kind of like when you think about when people talk about the market and bubbles. That's usually the point of euphoria, but it's also the point of maximum financial risk. And then the market, as it invariably does, it goes. Markets go up and markets go down. It starts to go down, and we start to feel more anxious. Then we start to deny what we're seeing, and we think, it's just a temporary setback. But then the market keeps going down, and we go through fear, and we go through desperation, and then panic, and eventually we capitulate. It's like, maybe it's not right for me to be in the market. We sell out at the absolute worst time. And then the market starts to go back up. And so like if we go back to 2009, which is probably the worst market that any of us experienced, in 2009, the market went down over 50% over that 2008 to 2009 period. But it's higher now than it was then. If you had just held on through all that, at least most investors would have been ahead. Doesn't mean that everybody would, because it depends on what you're invested in. I mean, I was looking at an account for a client today that just came over to me, and she had some funds in her account that were there since 2014. And the market's been up every year over that period. And even though the market's been up, the fund that she had been put into by the person that she worked with previously, it was down. And so we sold those funds at a loss. So once you have a plan in place, you have to commit to regularly updating and review it. I know for myself, one of the things that I like to do is I use Quicken. There's also mint.com. My financial planning tool is made by Right Capital, and they include something that'll help you with this too. And so what that does is you can link any of those tools to your accounts, and they can help you track your investments. They can help you track your performance. They can help you track your income and your expenses and make sure that you're on track. Do you have to do it every day? No. I don't recommend anybody look at what their portfolio is done on a daily basis, because that's how we tend to overreact to market movements. It's much better to look at it less, because the less you look at the market, honestly, the better chance you have of it going up. I had written a blog post a while ago, and I talked about how, and I don't remember the exact numbers off the top of my head, something like 54% of the time the market goes up on any given day. By the time you work your way up, and by the time you get to 10-year periods, you look at 10-year periods, the market's up like 90% of the time, 95% of the time. The longer the period is, the more likely the market is to be up. Okay, after we've gone through the understanding and we built, now we have to maintain. So that's so for me, like I think about that. Part of that maintenance is how often are we going to talk? So for me, each client's going to receive a minimum of 6 personal contacts per year. In addition, I deliver a signed fiduciary oath to each client. For those that aren't familiar with that, and we'll talk about it a little bit more, but a fiduciary is somebody that always works in the best interest of their client. Their client's best interests come ahead of their own. Each client is entitled to, in addition to those 6 contacts, up to 2 reviews during the course of the year. These can either be in person or virtual. And I continue to place an emphasis on and educating clients. I want them to understand the why behind my recommendations. I have an open door policy though, so if people have questions, they're always welcome to reach out to me anytime. And I promise to get back to everybody within 24 hours. It doesn't mean I'll have the answer in 24 hours, because sometimes it takes a little bit more work and research. But I want to make sure that I can get back to people quickly and let them know, yes, I heard from you. Yes, I'm looking at it, and I'll get back to you as soon as I can. And then the other thing is, you want to make sure you stay on course. And that's when you want to update your plan. So all these things that I'm talking about are elements of your financial plan. You can do them on your own, or you can do them with help. It's really up to you. So it's also important to think about visualizing. Visualizing can help us achieve our goals. So when you think about your financial plan and getting to retirement, there's a quote here from Norman Vincent Peale. He says, to formulate and stamp indelibly on your mind a mental picture of yourself as succeeding. In this case, that means achieving your financial goals. Hold this picture tenaciously. Never permit it to fade. Your mind will seek to develop the picture. Do not build up obstacles in your imagination. And what that's really saying is that if you picture that and yourself achieving your goal, it becomes a lot easier to do it. I know I went through an exercise like that when I started my business. So I kind of have like a view of where I want to be in 1 year, 3 years, 5 years. And I keep that in my head and even longer. And keep that in your head. It's the same thing with your financial plan. Know where you want to get to. Think about a path that's going to get you there and hold on to that. And you have a better chance of succeeding. And then the last one of the shifts that I'm talking about is work with a fiduciary. And like I said, a fiduciary is somebody who's always going to work in your best interest. If you want help, if you want to do it on your own, this doesn't matter. If you want to get help from somebody, I highly recommend working with a fiduciary. The difference is that other people work under a suitability standard if they're not fiduciaries. And what a suitability standard means is that they only have to do things that are suitable for you, but they don't have to be what's best for you. And that can make a big difference. So I'm going to go through a couple case studies now of some people that I've worked with and what we've been able to do. So my first case study was Jack and Jill. When I first met them, they were working with a broker, and that broker worked under a suitability standard. They told me that they weren't paying anything to this broker for the work that he was doing for them. They also weren't making any changes to their portfolio or that of their children. Well, when they gave me their statements, and I'll tell you that their statements were over 100 pages long, and they didn't really understand what they said. And I started to look at the funds that they were invested in. Those funds had expense ratios, and that's really what the fund company takes for managing the fund. That's their fee. Well, those funds had expense ratios from 1.75% at the low end to 2.25% at the high end. And they had children who were invested in bond funds, which really weren't, to be honest, they weren't even suitable for them at all. So what was I able to do for them? First of all, I was able to reduce their spending on financial advice because I know that expenses are important and they're one of the key drivers of your long-term returns. So I do everything I can to manage those returns. So I know when people work with me that they're paying me. And I want to make sure that they're not paying a lot beyond what they pay me. So I pay very close attention to the expense ratios of the funds that I put my clients into to keep their expenses down. The most expensive fund that I've ever put a client into has an expense ratio of 0.47%. And on average, I would say that the funds that I use are at 0.08 to 0.12%. So that's a lot less. So like I said, even if you put a fee for paying somebody like me or any other fiduciary, it's going to be a lot less than those fees that I talked about with those other funds. Plus, they're taking other fees on top of it. Sometimes you pay upfront fees, so you might pay 4, 5, 6%, 5.5%. You might pay upfront just to get into a fund. So what that really means is if you bought a fund for $1,000 and it had what's called a front load of 5.5%, that means you paid $55 up front. So that means your investment is now worth only $945, and you have to earn almost 6% just to get back to even. The other thing that changed for these people by working with me is that they have a portfolio that better fits their needs. Their allocation to different assets is more in line with what they need, what the time horizon is. And one of the things that I do with clients is I put together an investment policy statement, and that investment policy statement kind of spells out if there's some reason that you're going to need money in different time intervals. We want to make sure that we're prepared for that. We want to make sure that it incorporates your risk tolerance. We want to make sure that it includes your goals, things like that. And the end result is you have a more informed review of retirement at the end. The second case study, we'll call them Fred and Ethyl. So when I first met Ethyl, she was unaware of the spending path she and her family were on. If it had continued, they would have started to take on consumer debt. So when they came to me, I asked for some information on what they were spending because they didn't really have an idea. And my client Ethyl sent me some credit card statements and checking account statements. And I went through them and I sorted them and I told them what they were spending. And I look at those expenses relative to their income and realize that if they stayed on that path, even though they didn't have any credit card debt at the time that they came to me, if they stayed on that path, they were going to, because they were spending more than they should have. They had to change Ethyl had worked for a large company and was making a much larger salary earlier in her career, and then over time she decided she wanted to make some changes to her life and her lifestyle. And when she went to a lower paying job that fit better with what she wanted to do, that changed the family income. Her husband's income went up some, and that picked up some of it, but they were just spending too much, and it was going to really impair their ability to have the retirement that they wanted, and they have a child that they want to put through college, and it would have potentially impaired their ability to fund that college education. So at the end result is they had a budget to better manage spending. They have greater confidence that their college tuition bills can be paid, and they have greater confidence about what retirement might look like and their ability to have the retirement lifestyle that they would like. So again, I'm going to go through this a little bit more now. This is my pathway to an informed retirement that I introduced before. Like I said, it starts out with, point A here is retirement uncertainty. You really don't know what retirement in the future holds. Start out with a strategy session to determine if it's a match. Sometimes the person that you talk to, it's not the right advisor for you. Sometimes the client's not the right client for the advisor. So it's important that you make sure that you can be comfortable working together. You want to make sure that you understand what the goals are. What are your goals? What are your dreams? What are your challenges? You want to understand if you have a plan, is it up to date? If you don't have a plan, you want to start putting one together. The first step in putting that plan together is understanding your risk tolerance, as we talked about before, and identifying what level of risk you're willing to accept. Making some recommendations. What changes should I make? Changes to my spending, changes to my savings, changes to my goals, whatever the case may be. And then you want to be you have this roadmap that you're building, and you want to make sure that you're on the right path. And like I said, after that, we want to maintain. So we have regular reviews. I want to have an open door policy, and we want to make sure that we're staying on course. And that's what leads us to what we hope is a more informed retirement. So again, here's what we covered today. We talked about building a solid foundation in retirement, understanding where you are today, knowing what your goals are for the future, creating this pathway to an informed retirement, and putting in place a plan to stay on course. And like I said, all these steps, those are things that you can do on your own, or you can do it with help, and it's really up to you. I mean, I think one of the things I say about Apprise is, most people know that finances are important. So at Apprise, my view is I work for my clients because they might not have the expertise or desire to attend the way that they should to their investments on their own. They know they're important, and they want to have a trusted firm working for them, and that's why Apprise exists. It's also, the other way that I think about that is people that, many people have the knowledge to do all these things, but there's two other things that go with it. You have to have what I call KIT. It's the knowledge, it's the interest, and it's the time. As we get older, and as our children get older, and as our responsibilities and work increase, it gets harder and harder to find the time to do these things ourselves. And that's the other reason that firms like Apprise exist, to help people that know these things are important, but they lack at least one of those elements of KIT. So hopefully I've delivered on my promise. I've gone through a step-by-step process to help retirement-focused investors achieve financial confidence so they can live a comfortable lifestyle. How you can understand where you are today, how you can then build a plan to help you get to your retirement, and how you can maintain and follow that plan so that you can stay on track. So now you have a choice. I can help. I've set aside some time in the next few days to speak to you personally about how I can help you be more confident about retirement. During the session, I'll work with you to craft a step-by-step game plan to help you build your game plan for retirement. And the cost to you, nothing. This is absolutely free. Who's this for? As I said before, it's for 40 and 50-year-olds primarily. If you're still working though, all these things still apply. And I do have some clients that have retired already, and it works for them too. It's just at a different stage, because the difference is when we're working, we're accumulating assets, and we stop working, we go into the decumulation phase, because we start to use those assets we've built up during our working life to help fund our retirement. This is for families who want to maintain their lifestyle in retirement, those who would like to support their children's educational pursuits, people want to be more informed about what retirement might be like. I can tell you that sometimes I get calls from people and it's like, I want to retire in a year. Can I? It's kind of late to be answering that question. It's a lot better if we can address these things ahead of time. And the families I work with, as I said, typically have at least $250,000 in assets. Why am I doing this? Giving is getting. It's the concept of reciprocity. I like to inform, as I said earlier. I like to give back. So the view is that whether it's from my clients or somebody else, if you give to people, eventually you get back in another way. This is just straight up coaching on the best ways to be more confident about your retirement. Plus, I know that at least some of you might want help. If so, we can discuss it, see if it's a good fit for both of us. If not, that's fine too. I understand. So if you'd like to set up an appointment, you can get this link here, the bit.ly link is to my calendar. You can click on that and you can go ahead and schedule a strategy session. It's a free 30-minute session and we can have a conversation and I can see what I can do to help you get on track to have the retirement that you would like. So you're welcome to click on this link anytime and sign up for a strategy session now. And that's really all I have for everybody. If anybody has any questions, feel free to put them into the chat. And if not, I will call it a seminar. And I want to thank you all. I want to thank everybody for coming.